How do retail giants like Buffalo Wild Wings, Go, and Foreman Mills impact the commercial real estate landscape in central Pennsylvania? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In recent months, a series of significant commercial real estate transactions have taken place across 8 south central Pennsylvania counties, including notable leases and sales in the retail sector. Among these, Buffalo Wild Wings, Go, and Foreman Mills have established new presences, enhancing the retail landscape of the region. Buffalo Wild Wings Go has leased 1,508 square feet of retail space at the Point Shopping Center, located at 4023 Union Deposit Road in Lower Paxton Township. This move marks a strategic expansion of the restaurant chain's footprint in the area, aiming to capture the local market's demand for convenient dining options. Simultaneously, Foreman Mills has taken over the former Big Lots store in Madeira Plaza at 3215 North, 5th Street in Muhlenberg Township. This lease signifies a revitalization of the retail space, bringing new energy and consumer interest to the area. These transactions are just a few among the 34 commercial real estate sales and leases recently announced in the region, showcasing a dynamic shift in the commercial landscape. The influx of established brands like Buffalo Wild Wings Go and Foreman Mills is expected to drive foot traffic and stimulate economic activity, benefiting local businesses and communities. In the broader context, these developments in Pennsylvania reflect a growing trend across North America, where strategic retail expansions are reshaping commercial real estate. As cities like Kitchener-Waterloo, London, and Cambridge in Ontario also experience similar retail growth, the cross-border relevance of such transactions becomes evident, highlighting the interconnected nature of North American markets. In a notable transaction within the commercial real estate sector, Turnbridge, a Manhattan-based developer, has made headlines by acquiring a substantial property in Queens, New York. The developer has been actively purchasing industrial properties in the outer boroughs, and this latest acquisition comes with a price tag of $20 million. The site, located at 2025 130th Street in College Point, Queens, was purchased by Turnbridge as a stalking horse bidder. This strategy, often employed in bankruptcy auctions, allows a potential buyer to set the minimum bid for the property, ensuring they have the opportunity to acquire it if no higher offers are made. Turnbridge's aggressive expansion in the industrial real estate market reflects a broader trend of growing interest in these types of properties, particularly in the New York City area, where space is at a premium. When we look at this development from a cross-border perspective, we see similar trends in Canadian cities like Kitchener-Waterloo, London, and Cambridge in Ontario. These cities are experiencing an increase in demand for industrial spaces due to their strategic locations and burgeoning tech sectors. This parallels the industrial property boom seen in New York, showcasing the interconnected nature of the North American real estate markets. As developers like Turnbridge continue to expand their portfolios with strategic acquisitions, it will be interesting to observe how this affects the overall commercial real estate landscape, both in the United States and Canada. Industrial properties are increasingly seen as valuable assets, and their development could drive significant economic growth in these regions. A historic site in Center City, Philadelphia is on the market, promising a significant development opportunity. The property, located along Irving Street, includes parcels that feature a building designed by the renowned architect Frank Furness. This site offers potential for a transformative project, with the possibility of constructing a 20-story building that could house 128 residential units. The availability of this site presents a unique opportunity for developers looking to invest in Philadelphia's vibrant Center City district. The inclusion of a Frank Furness-designed building adds architectural significance and historical value to the property, making it an attractive proposition for those interested in preserving and enhancing the city's architectural heritage. This development prospect aligns with broader trends in urban real estate, where historic sites are being repurposed to meet contemporary housing demands. In cities like Kitchener-Waterloo, London, and Cambridge in Ontario, similar initiatives have seen historic properties revitalized to accommodate modern residential needs, reflecting a cross-border relevance in urban redevelopment strategies. From an American perspective, the potential Center City project mirrors trends in urban centers across the United States, where developers are increasingly drawn to historic sites for new residential developments. This approach not only preserves the architectural integrity of these sites, but also contributes to the urban fabric by providing much-needed housing. As the commercial real estate landscape continues to evolve, the sale and potential redevelopment of the Center City site stand as a testament to the ongoing demand for innovative residential projects that blend historical preservation with modern living solutions. This trend is expected to continue, driving growth and revitalization in urban areas, both in the United States and Canada. The Greater Chennai Corporation is taking decisive steps to address the issue of disproportionately low property taxes on commercial properties. Through a comprehensive data purification initiative, the corporation is focusing on identifying commercial properties that are currently underassessed, despite having a large built-up area. This initiative involves the use of advanced data analytics to pinpoint properties that require reassessment of their property taxes. As part of this effort, notices are being issued for the reassessment of property taxes on identified properties. This move is expected to generate an additional demand of around 80 crore rupees every half year. The corporation is also collaborating with agencies such as Tangedco and the Chennai Metropolitan Water Supply and Sewerage Board to conduct data mapping exercises. These efforts aim to identify unregistered and underassessed properties, ultimately improving tax compliance and reducing leakages in the system. To further enhance their database and increase tax demand, the Greater Chennai Corporation has embraced technology through its Geographic Information System project. This involves the use of drone and satellite imagery technology to create a comprehensive citywide spatial database. Such technology enables the identification and mapping of underassessed and unassessed properties, thereby boosting property tax revenue. The GIS initiative alone has generated an additional demand of 65 crore rupees for every half year this year. The corporation has reported that out of the total 13,84,000 property tax assessees, 6,82,000 have paid their taxes this half year. This marks a 14% growth, with collections increasing from 577 crore rupees between April 1, 2024 and July 6, 2024 to 658 crore rupees during the same period this year. Interestingly, residential properties across all 15 zones of the city have been exempted from this reassessment exercise, allowing the focus to remain solely on commercial properties. This strategic focus underscores the corporation's commitment to ensuring fair tax practices while enhancing revenue generation from commercial real estate. In the realm of real estate investment, the age-old debate persists: residential or commercial. Each offers unique advantages and challenges that can significantly impact an investor's portfolio. A recent discussion between experts Tim Graham and Ben Carrington sheds light on this topic, focusing on the pros and cons of residential versus commercial property investments. Commercial real estate is known for offering higher net yields, typically around 6%, compared to the 4 to 5% yields seen in residential properties. This higher yield, however, comes with the requirement of larger deposits, often reaching 30%. In today's high-interest environment, these attractive yields have drawn more investors to the commercial sector. One of the challenges in commercial real estate is data accessibility. While residential property information is readily available, commercial data can be harder to source. This can pose challenges for investors, particularly those new to the commercial market. Risk assessment is another critical factor to consider. Commercial properties can experience longer vacancy rates, potentially affecting cash flow. Strategies such as purchasing tenanted properties can help mitigate these risks, but careful consideration is essential, especially for newcomers to the commercial real estate market. Shifting the focus to residential real estate, recent trends highlight a growing preference for apartments over traditional houses. In Australia, for instance, apartments are outpacing houses in capital growth, offering lower prices, higher yields, and promising capital growth. This shift is driven by increased demand from downsizers and yield-seeking investors, as well as rising construction costs. A report analyzing 248 suburbs found that approximately 70% show apartments outperforming houses in terms of price appreciation. This underscores a new paradigm in real estate, where modern apartments are better designed and situated closer to public transport, enhancing their appeal to a broad range of buyers. In conclusion, whether to invest in residential or commercial real estate depends on various factors, including yield expectations, risk tolerance, and data accessibility. Each sector offers unique opportunities and challenges that investors must navigate carefully to maximize returns. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.